Whereas debt yield is why lenders get out of bed in the morning, right? It's how much money they're making on the money that they're putting out, which is typically going to be between 8 and 12%, depending on the asset class. Maybe some more risky stuff like hotels, probably 11 to 15%. Maybe some less risky stuff like, triple net retail 10-year deal with like a Starbucks, probably closer to 6 or 7, maybe 8%. You could probably see kind of where I'm going with that, right?
Yeah.
Longer the term, more risk averse, less debt yield. Less of a term, more risk, higher debt yield. Higher risk, higher return. That's life.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Culby, welcome to the show. How you feeling today?
I'm feeling great. Wednesday morning, it's early, getting the day started with a good meeting with yourself. So I feel good about it. How about you?
I'm doing very well, and I like a good early morning meeting. I feel like it gives you even more purpose to get up, right?
Sure. Gets the thought process going a little bit more, shake off yesterday.
Yeah, exactly. Well, let's start with introduction. I mean, I always like to hear you introduce yourself and tell us who you are, what you're doing, why you're here, all that kind of stuff.
Yeah, absolutely. So Culby Culbertson, I'm based out of Dallas, Texas. I've been in the real estate space about 6 years, specifically in the capital market space, debt, equity, variations of ground up construction, value add renovation, acquisitions and refinances, pretty much across all the core assets. My background going into, I guess, out of school was I was an oil guy with Halliburton back when I like to say back when oil was cool. I was out in West Texas, and then 2016 had the opportunity to come back to Dallas and kind of found my way in the private equity front office sales space and really snowballed that into the real estate realm that I play in today. So that's kind of a snip about me, and we can take that and run with it.
Yeah, well, very nice. Was real estate always kind of the goal there, or did you think you were going to be in the oil gas realm? How did you make that transition?
Yeah, that's a good question. I feel like, both industries are very interesting. I mean, I'm still vested in 5 different wells now with a good friend of mine who's an independent operator. But I've always had an interest in the real estate space, especially being in Dallas. A lot of guys that went to school at Texas Tech where I went, either in real estate or in oil and gas. So you just got to pick one, you know? So I feel like I've always had that knack for it. And then once I really started diving into it, I realized that that was a place that I should really focus some time in. And lo and behold, here we are.
Yeah, well, I always think it's I always like that line of questioning to hear the kind of progression, because I think the audience, accredited investors, some of them are working regular, full-time jobs, and real estate's kind of that
Sure.
side dream, something they want to get into. And so to hear how other people were able to navigate the space and then their evolution, because it sounds like you've had quite the evolution of, starting off with fix and flips and doing some GC stuff and all that, and to where you are now on the capital market side. Talk to me about how your relationship and your career in real estate has evolved.
Yeah, absolutely. So, just as you alluded to, getting my start, doing some single family flips. It's not like I was doing you know, the sexy work, right? We were, doing the demolitions and really understanding how a lot of these deals get started, frankly. Sorry, I had some wires that are no longer on the table now on accident. Uh, we, uh, we were doing quite a bit of volume in that case. And then as you continue to meet people in the industry, as you likely know, getting in the social media groups, going to the networking events, really from there, like the next level is to get into the multifamily. So as you meet more people in the industry, obviously the goal is to meet more advanced experience.
Yeah.
As you continue to meet more advanced experience, it's almost a natural curve that happens. So I feel like that was a big part of me kind of finding higher ground, if you will. And as that progressed as well, you kind of figure out, okay, on the multifamily side as well, there is a level of more of a technical analysis, understanding the P&Ls and how the math behind it makes sense for you to, to pursue it. With that said, then you start meeting the folks on the capital side. You start meeting the bankers and the debt funds and the hard money guys. And then that light bulb goes off. You're like, well, this is how it really turns. And that's when I just so happened to fall into a scenario with my previous life. And we grew that business from me and him on his poker table in his living room to, 15-person business. And I was doing about 100 million in loans a year independently. And here we are now. So, I mean, I think that, really locking into kind of what your focus is, right? So the first you was single family, then you figured out multifamily, then you realize you wanted to get on the capital side, locking into that focus and then meeting people consistently at each level is a really good way to streamline and frankly, make it a lot faster, kind of catapult yourself by doing it that way.
Mm-hmm. Yeah, definitely.
To your question.
100%. I mean, I think that's great insight for anybody listening. It's the kind of business where it evolves over time, because it takes time to learn different things, to meet different people, and sometimes just for things to kind of click. You know what I mean? And I think that's one of the loan side of the business, the debt side of the business, how deals are structured in that way is something that, I think people, they understand it to a certain degree, but the whole kind of the background of it and what goes into it and what you actually do as a debt broker. Let's talk about that. I mean, let's talk about what the business is, what it entails. And when somebody says they're in capital markets, what does that mean? I mean, I feel like that's something, let's get into what that means and, we can take it from there.
Yeah, absolutely. So with capital markets, it is almost exactly how it sounds with a ton of nuances, obviously. So there's variations of capital that's available to us as investors. So if Peter and I are going out to buy really any asset at all, the type of capital that's available to us, there is not to sound too straightforward, there is a market for that capital, right? So there's banks, there's agencies, there's different debt funds, private capital, institutional capital, what have you. And I'd say that the first rule of thumb is to better understand the asset that you're working with, right? So we'll just use multifamily as the example because that's the more commonly pursued or understood asset, I think, for a lot of the up and coming investors out there. So when you have an operating business, you obviously have profit and loss statements. Those profit and loss statements trail back to whatever time period you want. Based on that income and expense, your property is netting an X amount of dollars. Based on that X amount of dollars, you have to also take into consideration what your debt is. They call it debt service. So calculating your NOI, essentially your net operating income, and then also calculate against that your debt service. There's a few different ratios that you can calculate to show how well this property is performing and how well it's going to be perceived in the marketplace by some of these particular types of capital sources. So a big part of what we do, honestly, Peter, is vetting these deals, going through, making sure they have the right information, doing the analysis on understanding their profit and loss statements, their rent rolls, maybe even looking at their pro formas, which is basically an indication of how it will perform in the future. And there's other nuances to that too, like your CapEx budget and your management company. Not to get too deep in the weeds on all of those, but you can imagine that it's not necessarily just taking something off the shelf and saying, "Here you go, Peter. Appreciate you coming in. Take this and run with it. And let's hope you do your best."
Yeah.
You really have to better understand how the property has been performing. Typically, it's trailing 12 months. It's the document itself is called a T12, a trailing 12. So that they look at the last 12 months, sometimes even longer, especially with the agencies. If you're getting a non-recourse loan for a 10-year deal, you're likely going to be, a little bit of some scrutiny as far as how you've been performing for the last 12, maybe even 24 months, maybe further, especially in some down markets that we've recently seen in our recent lifetime. So with that said, it really is a combination of a lot of information, understanding how to digest that and convey that to the subject party. And based on that information, they're going to give you an indication of how we can finance it, aka how much money you can make on this deal, frankly,
Mhm.
because no deal is a deal without understanding what your debt is, unless you pay cash. But then you can only do that deal for a lot of times,
Yeah.
because then, where are you going to get the rest of your cash at? So you leverage your money with debt. So I think that was a really interesting, just ideology of the capital markets in general, is I really believe that without, debt in this market, it would be almost impossible
Mm.
to maneuver. So that's why it really intrigued me and kind of brought me in the business as deep as I have over the last, say, 6 years.
So the obviously the underwriting part is such a big aspect to that side of the business. How did that, what was the learning process there, and then what would be some maybe advice for, somebody who's looking to invest in these deals on the equity side, how they can underwrite, or how they can kind of verify the underwriting,
Yeah.
that they're seeing in a deck or something like that.
Yeah, I'll tell you what they do. They call us. They call us, and you give me the information on the deal, and we'll run through the underwriting together,
Mm,
rather than me just, provide all the insight of how to do it. I think the best way to do it is to work with someone that knows what they're doing,
mm,
whether it's me or it's, Joe down the road. I firmly believe that having a second set of eyes, especially with a lot of the groups that are out there, to be honest, you don't know who's on the other side of that webinar, and you
sure.
really have to do your own work, just better understand your work, compare it with somebody else. But I think that by having the initial diligence, Peter, is a big part of it. Having a needs list that's going to be fruitful for your final, your final results. But if I were to put my thumb on a few things, I think really understanding the math behind it, calculating some of the basic equations, getting your NOI, getting your DSCR, getting your debt yield, your yield on cost, which is all pretty basic equations that you could Google right now and it
Mm,
would pull it up immediately. Um, and I think that having that quick understanding is the best way to be able to sift through a lot of deals.
mm.
Because, only if the first deal that hit our desk was the deal, we'd all be on private jets to some foreign country right now. That's just not the case. You got to kiss a lot of frogs. It's just a fact
Sure.
of it.
Yeah. I think that's great insight, and especially the working with somebody. I think people, especially accredited investors, they didn't get to where they are today without forging their own path in a lot of instances, and kind of being contrarian maybe, or not so, just doing their own thing. And so a lot of times I think when it comes to analyzing deals or the underwriting, all they want to handle all that themselves, whether or not they maybe have the skill set, and I'm sure they don't, for somebody compared to somebody like yourself who's doing that every day. And I think bringing it to somebody like you to get a second eyes on it, I think that's great. Great insight there. What do you do from, like, you mentioned the pro forma? What's some advice there to kind of verify? You know what I mean? Other than just going on Google, I mean, is there
Right.
any other, because I feel like that's a lot of times where they play games, right? You know what I mean? To your point of
Sure.
the guy behind the webinar, I feel like that's always the biggest concerns and, topic for debate is those, because the T12 is what it is, right? You know what I mean? Could it be missing some stuff, or could you
Right.
need extra stuff? Yeah, I mean, I'm sure there's a lot of times when you are digging for more information and stuff like that. But the projections forward, that's what's going to kind of make or break the return and the business plan and all that kind of stuff. So is there any kind of tips you can provide there with verifying that, and maybe it is as basic as just getting on Google and looking for comps and, kind of trying to verify, the market and what they're saying increases are and stuff like that. So what's your thoughts?
Yeah. So I think there's different types of resources out there to where you can pull, real-time information, Yardi and CoStar and things like that. At the end of the day, I think that by looking at historical data is going to be probably one of the better factors, and historical data is typically retrieved, I guess you'd say, by like investment sales guys, other investors. So that goes back to my point at the beginning of our conversation, Peter. Really being in the know and the network is going to be extremely helpful for you because having some contacts that are, investment sales guys, brokers, having some contacts that are investors, okay, hey Peter, hey, what do you think about this? I'm quoting insurance at 750 a door. What'd you do on that McKillen property? Or, hey Bob over at Marcus and Millichap. Hey, I'm trying to get this deal sold at like 150 a door. It's a 1980s product. What do you think about that? So are there things you could do on CoStar and Yardi? Yeah, for some back of the napkin, yes. But I've really found my way to do stuff is calling the guys that are really ground level, and that's the investment sales guys, calling appraisers, calling guys that are actually doing deals. And it's really like, listen, especially in commercial real estate or just in real estate in general, it is a small world out there.
Sure.
So if you do right and you have integrity about what you're looking to find, they're gonna talk to you. Hey, just wanted to see what you're seeing on a rent per square foot in the M Streets area. Oh, well, Colby, I'm seeing like $2 a foot, maybe even $3, depending on the deal. They're not going to be like, whoa, listen, buddy, it's not like you're asking who they voted for. You know what I mean?
Yeah, they
But,
shouldn't take too much offense.
well, yeah, but I think that there's a lot of means to find the information. And here's what I'd say also about a pro forma is that you can create whatever idea you want in your head. That does not mean that your capital is going to follow you, right? If you've got some extreme assumptions that are outside of what the market, one, it is available or you can find, they're not going to follow you. They're not, especially in the world that we live in today, when we're kind of in a place where appraisers are coming a little bit further down on their valuations. Lenders are showing more reservation because of some of the mistakes that have been made in the last, say, 5 years of real estate as certain asset classes, specifically multifamily. Frankly, I don't see, any assumptions that are outside of what the market holds to be followed by the experienced lender or investor or whoever that may be. So I think it's very prudent to follow the steps that I just outlined, calling some of the investment sales guys, calling some local investors, maybe even getting in touch with an appraiser, which it's not difficult to do.
Sure.
And then getting some of that really basic information, expense ratios, rent per square foot. Just with those two details alone, I really feel like you could take a lot of deals from where they are today to where you want to take them with just very basic information.
Yeah, I think that's really good insight. And I think for an accredited investor that's looking to invest equity into a deal, on the LP side or something like that, they can do all those things too. You know what I mean? I don't think and I'm sure a lot of them do, but like if you don't, it's good reminder, for people who, if you're analyzing a deal and you're questioning the projections or you just want to verify, and make sure they're in line. I think you'd be surprised when you pick up a phone and call people, especially in that business, where if you're calling brokers or appraisers, they're used to being on the phone all day. And it's just, they'll talk to you, and they'll be honest with you. You might want to call a few, just in case, just to get various opinions, because there's always different levels of people who get shit done and know what they're doing versus people who maybe don't. So you don't want to just talk to that guy. You might want to verify, but I think that's really good insight that people sometimes forget they can do or don't think, oh, I shouldn't call this person or something like that. It never hurts to pick up a phone and ask a question, see what happens of it. I think that's great. So how does it work? Like how do you get all the back end? So when you get a deal in, you underwrite it, you feel like, okay, there's something here. The things are lining up. Is there anything there, like before we move to that next question, is there anything that you want to see? Like, is there anything like what makes you say, okay, this has potential versus this doesn't? What's like the red flags and things like that before we go to, who you're bringing these to and all that kind of stuff?
Sure. So going back a little bit in our conversation about finding some of those, common metrics. So debt service coverages, debt yield on cost, understanding what those mean and who they mean most to are really going to help you better understand how a deal sits today. So the way that I'll answer this is by debt service, because your debt service coverage is why the investor gets out of bed in the morning. It's how much
Mhm.
they're making after you pay all of your bills and also your debt.
Mhm.
That debt service coverage is going to give you a metric, which is typically a 125, actually really more like a 135 in this world we're in today. Whereas debt yield is why lenders get out of bed in the morning, right? It's how much money they're making on the money that they're putting out, which is typically going to be between 8 and 12%, depending on the asset class. Maybe some more risky stuff like hotels, probably 11 to 15%. Maybe some less risky stuff like, triple net retail 10-year deal with like a Starbucks, probably closer to 6 or 7, maybe 8%. You could probably see kind of where I'm going with that, right?
Yeah.
Longer the term, more risk averse, less debt yield, less of a term, more risk, higher debt yield, higher risk, higher return. That's life.
Yeah.
And then on the other side would be yield on cost, because here's why. Most deals that people are buying in commercial real estate typically have some type of construction component, some type of operational deficiency. So all the cost that you have to put into the deal, your total cost basis, how much money are you making on the additional dollars you got to put in? Typically, you want to see something in that 7.5 minimum range. If you're anywhere below, realistically, 8%. If you're below 8% on your yield on cost, you better have a pretty good story, because it's going to be tough to get some of the more experienced guys behind you, because frankly, everything costs more already.
Sure.
So if you're already having trouble making it make sense with your basic model, now go out there and have shortages on supplies. Now have labor costs go up on you. Watch these tariffs come in. Not trying to bring politics into it, but it is what it is.
Yeah.
So I think the fluctuation in pricing on the commodities and different trades and things like that are going to affect your yield on cost for obvious reasons. So understanding those three pillars are really going to give you a foundation on your underwriting. I think, anything beyond that is a phone call.
And speak to me. You were talking about debt service coverage ratio. Speak a little bit more about that and what that means. I mean, to somebody that maybe is hearing that for the first time or doesn't necessarily understand, let's get a little bit deeper into that, because I think that's very important.
Yeah. So it's just your NOI divided by your annual debt service. And what that is, it just shows a fluctuating ratio that shows you where you're at on the Richter scale of you're making money or you're not making money. Typically, a 1.0 DSCR is cash neutral. You're not making anything, but you're not losing your tail. Anything sub 1.0, considered distressed, right? But frankly, that's where a lot of the guys out there are looking for that diamond in the rough. It doesn't scare a lot of guys off. That goes back to our point about having a good pro forma, understanding what a good expense ratio to anticipate is, understanding your property taxes, your insurance, your utilities, management, contract services. It goes all the way down. But if you're underwriting a deal that's distressed, you better know what those expenses are anyway, which you likely should. If you don't, give us a call. And I think that anything that's above, say, a 1.15, you're in a position to be quote unquote either en route to stabilization, or at 125 to 135, you're considered mathematically to be stabilized. And if there's any deeper questions in regard to that, I'm happy to answer those. But I think just really understanding the breaking point of 1.0 and 1.25 are the two primary numbers that I would say that investors should keep in mind when they're doing their underwriting.
That was great. I mean, just kind of a basic understanding. That's what it is, and that's kind of industry, standard, what it means. I mean, I think that's perfect.
I like this business, Peter, because it's just math.
Exactly right.
Like someone's like, well, I think this is a deal. That's like, well, the math says it's not. So if you want to argue with math, that's on you, my man. So I don't know.
That I'm sure you say that line once or twice a week at least, right? That's a really good way to put it. You know what I mean? I'm the kind of person that appreciates, kind of boiling things down to its simplest parts, and the math tells you it is or it isn't. And to your point, it might not be now, but what's the story, right? You know what I mean? What's the goal? Where are you going? And then how do you, just is that practical? Is there are you being realistic in that sense?
What's
Okay,
your ability to execute based on the assumptions that you
Yeah.
have, right?
Yep. Great. Okay, so that kind of leads us. All right, so now we got something that you're saying, okay, let's go. The numbers are making sense. You know what I mean? So it's adding up. What do you do? I mean, who are you bringing those to? You know what I mean? I'm picturing this, the capital markets. It's like, like you go to like the farmer's market or something. There's just a ton of vendors, you know what I mean? There's all
Sure.
kinds of different banks that are lending stuff. I mean, what does it look like to you on your side of the business? And then, what do you do a lot of like business development in that side and to get to other, different lending sources and institutions and whoever else, and everything in between, or what's that side of the business look like?
Yeah. So, we structure our day in a way to where we give everybody a little bit of time of our day, right? So call it Monday, Wednesday, Fridays. We're more so focusing on our pipeline and our investors and investment sales guys and things like that. But we do allocate some points in the week, oftentimes Tuesdays and Thursdays, to get on the phone with various types of capital. And I'll tell you, Peter, like once you understand, kind of where the money comes from, it's not hard to fish. Once you know how to fish, it's easy to find. And there's way more resources out there than what meets the eye, because it's not like they're out there advertising on television
Sure.
this bridge loan that's non-recourse 36 months, or this bank construction loan that's a 20-year amortization. Most people be watching America's Funniest Home Videos like, what, show me the Applebee's commercial.
Yeah.
But I think that once you learn what these banks are looking for, these debt funds are looking for, it's easier to find them, because the more research that you do, and there are different resources for everything, you can really understand how to find these folks by having a good package and underwriting, because you get on the phone with one lender or a capital source, private investor, whatever that is. And if you have a good package, you have a good deal, you present it well. If they're not the person, oftentimes they'll give you a couple ideas. They'll say,
Nice.
well, hey, Colby, this deal's not for me. You should go call Bank of America, which obviously that's not who I'm referring to, but example purposes. And as you continue to do that, it becomes a little bit more transparent on who you should be reaching out to. And every time we go to these particular capital sources, oftentimes we have a full package. We've already underwritten the deal. We understand who the players are behind the wheel. We know where they're going. We do our checks and balances on what's possible in the marketplace. We check guys every now and then, and gals, when they come in with their pro formas, and I say, hey, listen, Peter, I know you really want to get $5 a foot on this rent, but that is completely asinine. You know what I mean? Or your expense ratio is literally 5%. That's never happened in the history of life. So so we kind of like go back and forth a little bit. And by having that real conversation with your investor on the front end, by the time you make it to the marketplace, they really respect that. So they'll open up the doors for you, because they know that, you represent yourself well, so you're going to represent them well, as
Sure.
in conjunction with that. So I think, not to give the keys to the castle away too much on this, right, Peter, but I think that there's a lot of capital out there that's available to people that they just don't understand is available, whether that's community banks, regional banks, international banks, and debt funds, which there's a ton of activity with debt funds right now because of the reservation that we're seeing with the regulated banks. And there's a lot of debt funds out there that walk and talk just like a bank, and sometimes can be even more competitive. So I think it really just comes down to the type of deal you have, the experience behind the operator, the investor, and the expectations as far as rates, terms, how long you're going to be in the deal, if you have some type of construction component, and all of the other intertwining variables we've talked about today. it all kind of bolds into one on how you would identify the best capital source that's available to you.
Yeah. Well, talk to me about the fluctuations, in the marketplace and how you account for them, and yeah, how it changes your underwriting and all that kind
Sure.
of stuff. And maybe like we could speak to the last few years where there's been a lot of, a lot of changes and reservations, like you said, in certain parts of it. And then we'll talk about, thoughts, future state, that kind of thing. But let's
Yeah.
get into that.
Well, I'll give you the easiest top point for that, and that would be treasuries,
Mm,
right? Because treasuries move every day. We check it almost every single morning, and it's a big part of what we do, because it's all based on spreads.
mm,
So if you have, say, your 5-year treasury at 4.0, but then 2 months later, which oftentimes some of these close processes could be 45 to 60 days, maybe
yeah.
longer, depending on how well you got your ducks in a row. And between that time, if your rate jumps on you 20 basis points and now call it half a point, I mean, you're significantly changing the underwriting to a deal. And if
Mm,
those out there that understand how to calculate DSCR and things like that, putting your model a 5% rate, now putting your model a 5.5% rate, it's going to significantly change your bottom line. So I think having an understanding of what moves the fundamentals, as they say, job reports coming out and how many times the feds are meeting per year and things like that, all of those things are a good way to kind of be the expert in the conversation. Nobody's got a crystal ball and where they're going to go, but if you understand it to a degree, you can at least narrow down that very wide conversation to a little bit more of a controlled conversation, if that makes sense.
mm. Yeah, definitely. Any other kind of variables that are factored in besides treasury and stuff like that, or
Yeah, I would say like we kind of alluded to about the trades. I mean, look, if you're a developer and all of a sudden we've got a steel tariff that goes up 50%
Mm,
or a lumber tariff that goes up, or just the cost of lumber skyrockets, and or even oil, if oil goes up, the cost of oil goes up. I mean, look, at the end of the day, you have to get your materials somewhere. Your logistics to get there is going to cost. So your logistics costs will go up. Therefore, your costs will go up. Your materials go up. And then now, who knows about labor, with everything going on in the world, so like there's definitely a big factor on some of the microeconomics that are going on in
mm,
your local communities as
mm,
far as material cost, logistics. It's not just the cost when you're walking at a Home Depot. It's also the trucks that get there. It's also the cost of the drivers that are working. So I mean, there's so many factors that bode into that final product. And look, if your costs are just skyrocketing, it's really difficult to make a deal pencil. And if you talk to any experienced developer over the last 5 years, cost of your materials and cost of capital have been the leading indicator of delayed construction,
mm,
selling underwater, frankly.
sure.
Um, I think here's a good analogy with what the market has been in the last, say, 5 years or so. When you're swimming in from the deep end, some people are trying to find the ground to walk sooner than others, right? So the more that some people kick and look for that ground, you may even just try to find that ground, even if you go under to find it.
Mm,
Some people are kind of steady Eddie and go find the end of that shallow end very slowly, and they can weather the storm. So a lot of the mom and pops are sinking faster because they need to do that. The bigger guys are kind of wading through and they're kind of slowly but surely finding ground. So I think, the combination of cost of capital, cost of materials, labor shortages, that's causing a lot of people to find ground sooner, which is oftentimes taking them underwater.
mm.
Some of the bigger guys can wade through that. They've got more cash on them and they don't have to be so drastic in finding that higher ground. Does that make sense?
100%. Yeah, yeah, and it all kind of whittles down to the underwriting, right? At the end of the day, and how that
Yep.
all those kind of factors change those numbers pretty much up. Not so much on the down, right? You know what I mean, but I guess it
Sure.
could in some ways. So let's get the crystal ball out. What do you think moving forward? How do you feel about the rest of the year and just in general moving forward with the way things are? Obviously, leaving out any catastrophes and things like that. But what's
Yeah.
your thoughts? How do you feel?
Yeah, I'm optimistic. I think what I've learned, which I haven't been around forever, but I've been around long enough to, see a lot of the trends that have happened. And from what I've seen, everything goes in 5-year runs.
Mm,
So if you notice, even dating all the way back to 2008, 2009, there's a significant swing and then a little bit of downfall, significant swing, a little bit of downfall. And luckily, we're blessed as, up in the USA to have a lot of very sharp people kind of doing, some of this legwork on the back office. But I think that treasuries are slowly but surely finding their landing, right? I don't think it's going to be as low as people think. Because if you look back, this is like I said, historical as always. If you look back in 2018, the 5-year treasury is at 4.2. So right now, today, we are actually inside of where we were 7 years ago.
mm,
So if some people think that we're just going to go continue down because that's what we saw in 2021, I think that you're going to keep reaching and keep reaching. You're going to keep waiting. I think that we're finding a place to where we're playing ball at a kind of a normalcy at this time. And I think another good analogy to think about too, Peter, is thinking about the oil and gas industry. Because back when oil was 110 a barrel, 115 a barrel, yeah, it was nice, but everybody got that quick high on it. Like,
mm,
this is never going to end. Let's just keep rolling and keep rolling. And it ended. And it ended drastically, like so bad that it went negative. And it's taken a long time for people to get back to normalcy. Whereas if you can trade at barrels, say 70 a barrel to 80 a barrel, everybody's making money. I'd say the same thing with treasuries. If we can have treasuries between like 3.75 to 4% on the 5-year, realistically, if you're buying it right, everybody's making money.
mm.
You have agency quotes at 5.25%. When I was in 2018, 2019, when I was doing my first agency deals, we were quoting 4.8 to 5.25.
Mm.
And if you got that, you were playing ball. So
Yeah.
I don't think that we found the end, but I don't think that we're very far off. And people that are waiting for some drastic turn in the market in our favor, I think you're going to be waiting much longer than you anticipated or
Sure.
indefinitely.
Yeah, that makes a lot of sense. Well, what about yourself? What's the goal for you in the short term, long term? Yeah, you're looking to grow the debt business. What's anything you're get you excited maybe on the operational side or anything with that, or
Sure.
what's Colby looking to do?
Yeah. So, I mean, I appreciate that. So, I mean, just uh, if I were to take a step back and look at where I'm at right now, I would probably grow this business, the capital market side, as much as I can. Candidly, I would also do that as a catalyst to do other things as well. I am a GP in 2 multifamily deals. I've JV'd some self storage. I've built and sold a couple homes, building a couple more right now. Invested in some oil wells. I've got a small business that I'm about to be starting up again, another venture. Not to mention it right now, but details coming soon. So it's one of those things where once you get rocking and rolling, you have ability to do other things, right?
Mm, sure.
So I think I'm really passionate about the real estate space, really passionate about the investment space, but I think that where the world is turning to is into operating businesses. So
Mm,
banks are very fond of operating businesses. So whether that's, you're operating an HVAC company or, some type of service sales or product sales or something like that,
yeah.
I really think that's going to be a good way for you to continue to grow. Your overall financial wherewithal is by
Yeah.
diversifying and including some operational businesses that can get you outside of just the real estate space.
Yeah. It's interesting you say that because it's been something that has been just you're hearing more and more and more about it, and I think kind of the reasons for it. With some of the challenges over the last few years in the real estate space. As a real estate guy, especially with the experience in the capital markets and the underwriting, and maybe you can't answer the question, but like, what are some of the differences there? Because it seems like there's some benefits to those operating businesses, and like you said, the banks seem to look pretty favorably on them as well. What would be some insight there to investors that maybe have been hearing about that and want to get more involved? What are some of the motivators to do something like that?
I'll give you a great example. So COVID, which, that's everybody's scapegoat to make an excuse for, and I'm not doing that here. But what I would say is think about, say, a mattress firm. You have a single tenant mattress firm that's in a pretty heavily populated area. So now people aren't going out as much. They're definitely not coming in and laying on your beds. So now, and you have a fixed 10-year lease, but mattress firm can't pay you, or they're paying a less amount, right?
Mhm.
Or multifamily, people aren't able to go to work or whatever that may be. And now the landlords are suffering because their tenants can't pay, right? Whereas, say, we'll just say an HVAC business, you have operations going in, you have more than one person working out there for you, selling a service that people need. It's actual necessity in the marketplace. And whether you have low sales, high sales, you can tweak some things in your operational strategy
Yeah.
to where you can offset that. Whereas if you just have whether it's one lease or 100 leases, you're locked in.
Yeah.
And if they don't pay that lease, that's just what it is. It's not like you're just going to correct your expenses in a way. I'm going to stop paying my insurance. Are you? No, you're not. I'm going to stop paying my light bill. Are you? No, you're not. Whereas with an operational business, maybe you hire some more guys to get out there. Maybe you let some guys go, unfortunately, and you can start tweaking your operation to where you can have a more favorable outcome. Whereas with, net lease investment, you just cannot, you don't have that ability. And banks see that. Banks want operating accounts. They want operating businesses. Look how big the SBA program is.
Sure.
Even though they're in a little bit of trouble because of some of the loans they gave out back in COVID, which let's go down that rabbit hole.
Yeah.
But I feel like that's a big part of why investors are seeking that space, and why banks are favoring it in a big way.
Yeah. Yeah. Wow. What an awesome way to wrap up a great episode and a great conversation there. You left us wanting more because I think that's such a great topic, and it's something I've just been seeing a lot of it and reading a lot about it. So it was interesting. Funny you said that. Well, Colby, how can people learn more about what you're doing? You dropped a nugget there that you might have something coming out. So how can they get on your radar and learn more about what you do and who you are, and how can they get involved with you?
Yeah, thank you. So I'm pretty active on LinkedIn. So look me up on LinkedIn. I'll be there. You'll see a lot of the content that we have. You'll see my website, which is culbertsonholdings.com, gives you a fair idea of who we are, what we do. I'm pretty easy to get in touch with. As Deion Sanders says, I ain't hard to find. But
That's important.
I would love to connect with anybody that is like-minded and has an idea and would like some kind of direction, or frankly just wants to connect and have some synergies. That's why we're in the business. Would love to take anybody up on that opportunity.
Great. Awesome. Well, thank you so much. This has been a great conversation. I appreciate you being here.
Good. I appreciate you, Peter.